Quickly clicking, Canada's fixed mortgage rates are plunging following the dive in bond yields amid concerns over the economic havoc that would come to pass from U.S. tariffs.
It's incredibly swell news.
Yet, as we'll see, while the real estate industry is pushing the FOMO narrative that these falling fixed rates could be booster juice for home buyers, Friday's bond reversal shows that the interplay between geopolitical dynamics and domestic economic forces is not as simple as booster juice.
It's got electrolytes.
In fact, these lower mortgage rates could very well be short-lived if we don't see those tariffs materialize, as events of last week, both the surge in bond yields on Friday as well as the Treasury's refunding announcement, and Treasury Secretary Scott Bessent's comments about the U.S. 10-year Treasury altogether shows us that the interplay of international finance, geopolitics, and how those two forces affect our own domestic political economy is not as simple as rates are low, go buy a house. Meaning, unless some of the pressures that we'll discuss today subside, we're going to see either A, lower rates amid massive economic uncertainty, or we're going to see higher interest rates once things calm down.
You're getting one way or the other.
So what I want to do today is very briefly go over Canada's plunging mortgage rates, take a look at the events of last week and what they can tell us about interest rates in the absence of this economic uncertainty, and then go over some implications. As we'll see today, and probably for the foreseeable future, massive economic uncertainties continue to linger. We will obviously continue to track Canada's economy on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, let's get into these mortgage rates. Onto these falling mortgage rates. I am going to go over these rates a bit faster than usual, as I think the background story, what's happening behind the scenes, is what is mostly ignored by the industry and the media, and also, predictably, what is most important.
Interest rates are about to drop.
Onto the mortgage rates. First up, my best 5-year fixed insured mortgage rate, which is down substantially since January. In January, the best 5-year fixed was 4.35, and that is now sitting at 3.99 in February, with a variable sitting at prime minus 0.8 or 4.4%. Next, my best insurable mortgage rate, where you have that 20% down in a 25-year amortization. January's 5-year fixed was sitting at 4.64, and that's down to 4.44 in February, with variable sitting at prime minus 0.55 or 4.65%. And finally, the best uninsurable mortgage rate, that's where you have that 30-year amortization or you refinance your home, which was actually up this month, with January sitting at 4.64, now sitting at 4.79, with a variable sitting at prime minus 0.55 or 4.65%. Though I do expect that those fixed rates are going to come down within the next few days. The banks, the lenders don't always respond as quickly as the bond market. So we have insured mortgage rates, those with less than 20% down. Those rates are down about 35 basis points. Insurable mortgage rates, where you have that 20% down, those are down by about 20 basis points. Uninsurable mortgage rates, those 30-year amortizations or refinances, are up a bit since last month, but they should fall any minute now.
Tomorrow.
Yet there are a few key indicators from last week that tell us that this trajectory could very well be short-lived. Now, before moving on, I just want to first and foremost reiterate, as we've talked about this on this channel before, that it is the yields on government bonds that drive fixed mortgage rates. Yields are how much governments pay to borrow, and as governments are the safest borrowers in the world, allegedly, they pay less than you and I do to borrow money. Therefore, when their yields drop, you and I will pay less to borrow money as well, though we're going to pay higher than the yields on government bonds. And we had two big reports come out on Friday that sent the yields on Canadian government bonds surging. First, we had the employment data coming from the United States showing that wages were rising, and we also found out that inflation expectations were rising as well. That sent the yield on the 10-year Treasury 5 basis points higher, as traders bet that the Federal Reserve and inflation would remain higher for longer. If wages are going to be sticky, if there's a chance that those wages are going to work their way into inflation, then I'm going to want a higher return on my money when I lend it to the US government, as my purchasing power is going to be eaten away, relatively more so, by that inflation. And that news alone would have been enough to send Canadian government bond yields up. As we can see, the US 10-year and the Canadian 5-year move in near tandem. And I'll save you the suspense, it is the superpower to the south that drives that relationship.
Really?
But then we also had Canada's blockbuster jobs report, which blew past expectations, again leading the market to believe that inflation and the Bank of Canada could remain higher for longer. That pushed bond yields up the rest of the way, and we saw a total of a 12 basis point surge in bond yields on Friday. But it's not just unemployment and inflation putting upward pressure on bond yields. There's a bigger structural issue at work here, mainly how the United States Treasury Department borrows money. Last week, we got news that the Treasury Department would be sticking with the long-term debt plan that had been implemented by former Treasury Secretary Janet Yellen. If you'll remember, last summer, that plan was criticized by Nouriel Roubini for manipulating the Treasury market in what Roubini called active Treasury issuance. We talked about this last summer, but very briefly, what the Treasury Department had been doing, said Roubini, was relying more on short-term government debt issuance to fund the U.S. deficit, $2 trillion as of 2024. So rather than borrow at the long end of the curve, issuing longer-term debt, say 10, 20, or 30-year debt, Yellen had been relying on short-term issuance. And the reason why Yellen did this, of course, says Roubini, is that U.S. borrowing needs are so massive that had Yellen had relied on longer-dated bonds, had she had relied on those 10, 20, 30-year bonds, that would have been a massive amount of supply hitting the market. And when a massive amount of supply of anything hits the market, the price for that thing goes down. And since bond yields and prices are inverted, that would have sent yields surging higher. According to Roubini, 25 basis points higher, and if the U.S. stopped doing that now, that would send yields 50 basis points higher. So if the United States just changed the way it borrowed, started borrowing from the long end more and more rather than the short end, relied more and more on long-term financing, mortgage rates would rise by at minimum 50 basis points, at minimum 0.5%, and probably actually a little bit more, as the banks always grab a little bit more for themselves. But the problem lies in that borrowing more short-term, relying on short-term debt, could become a real problem if we get an unexpected inflationary surge.
That's impossible.
But if it did, then the U.S. would have all that short-term debt coming due in a higher interest rate environment, which could put real pressure on U.S. finances. It's very similar to choosing variable rate mortgages over that of fixed. It might be cheaper in the short term, but it could get much more expensive. It's risky. And this move by Yellen was criticized in the past by the now current Treasury Secretary Scott Bessent, arguing that by borrowing more than $1 trillion in short-term debt, Yellen was effectively distorting Treasury markets. As such, Wall Street had been worried about Bessent's plan, how he planned to manage that debt, as Bessent had wrote about his plans to term out those treasuries, pay off short-term debt when it came up for renewal by taking out more longer-dated term debt. And then, last week, in a real about-face, the Treasury Department announced that it would in fact be sticking with Yellen's debt plans, maintaining debt auction sizes for at least the foreseeable future. And the reason, of course, is that the Treasury Department is very well aware of what the real estate industry would ignore if it knew it existed. Mainly, that the relentless supply of U.S. structural debt going to the long-term debt markets would send yields, and thus mortgage rates, surging. But this is a short-term fix. The United States is eventually, sooner rather than later, going to have to increase the amount of debt going into the market, especially if those Trump tax cuts get passed this year, or any other spending measures get passed without offsetting cuts. So we've got this great big debt issue working its way in the background, a debt issue that Treasury Secretary Bessent even noted last week when he said that Trump and himself would be focusing on the 10-year yield, meaning the Treasury Secretary understands he needs to get the yield on that bond down, hopefully by cutting spending and making government more efficient, rather than getting the Fed to lower rates. And I think this is a very serious nod to acknowledging that the United States has a very serious debt issue, that it is in fact very limited in its borrowing capacity, understanding that there are going to be challenges in the U.S. attempt to keep rates low, as it is in fact the bond market that is calling the shots. An acknowledgement that we really don't see that often. So, in addition to the inflation and employment data that we got last week sending yields higher, we also have Treasury Secretary Bessent walking back previous criticisms of Yellen's debt management plan. openly telling us that the Secretary is very much aware of how much the bond market can move if the United States makes the wrong move. And then back here in Canada, we have our journalists talking about booster juice, a psychological stimulant that could send home buyers back running into the market. But what the story from Treasury tells us is that could very well not be permanent booster juice.
It's got electrolytes.
As we've all seen and as we've talked about earlier, bond yields and thus fixed mortgage rates are falling on these tariff threats. Yet, if those threats subside, especially amid worries about an inflationary surge, yields and rates are probably heading back upward, putting downward pressure on real estate. Alternatively, if these tariff threats don't subside, then yields are continuing down, but right along with the economy. Again, putting downward pressure on the real estate market. The path towards a revival in the real estate market involves A, a retreat of the threat over tariffs, and B, a retreat of inflation, and C, most importantly, a consumer that is confident that neither will return. Definitely a tall order in uncertain times. Yes, we are seeing lower mortgage rates. Yes, rates are down, some of them below 4%. Yet, they're down for a reason. They're down due to economic uncertainty. If that economic uncertainty dissipates, as last week shows, we're back to all of the other issues that we had pre-Trump era. These lower interest rates are all covering up background problems that are big, massive, structural problems that we've talked about on other videos. Either those low interest rates go away and those problems come to the forefront, or those lower interest rates probably get even lower, but we have an even bigger problem on our hands. With all of that said, we will continue to track how all of this plays out and how it affects the Canadian economy on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.